Welcome to the Womack Investment Advisors Forecast 2018, Anticipating Change. Thank you for joining us. And in this quick little presentation today, we're going to be talking about where we've been and where we are and just looking ahead in 2018. So just real quickly, the opinions voiced in this material are for general information and are not intended to provide specific advice or recommendations to any individual. So please visit with your financial professional before you act upon anything discussed in this presentation. So, talk about today, we're going to look at where we've been, where we are, and where we may be going. Well, 2018. Bears weren't happy about it, but throughout 2017, we watched the U.S. indices hit one new high after another. The S&P had hit new closing highs 62 times during 2017. That was the second most new highs ever. 2017 is tied with 1964 and trails 1995 when we saw 77 new highs. The Dow Jones Industrial Average recorded 70 fresh closing highs in 2017, the most since the late 1800s. As you can see on this chart, the S&P finished the year up 19.4%. The Dow Jones Global ex-US Index was up 24.6%, and the emerging markets gained 34.4%. So this tells you that the international stock markets, and particularly the emerging markets, were much stronger even than the U.S. Gold finished the year up 12.1%. The Bloomberg Commodity Index was slightly down for the year at minus 70 basis points, and the Dow Jones All REIT Total Return Index finished up 9.1%. Now, many emerging markets outperformed markets in the developed nations. As you can see, China outperformed all the emerging markets, and you can see the rest of them there. As you can see, the average, if you took the average of them all, still up roughly about 34% for the year for emerging markets. Pretty spectacular. Emerging markets had previously, by the way, underperformed the U.S. for several years in the last few years. So they've finally caught up and are actually in the earlier stages of bull markets than compared to the developed nations. In the United States, corporate earnings were up, which helped support share price increases. Now, earnings were better in some industries than others. So they were strongest in the energy sector and weakest in the telecommunications sector. But it's important to understand that strong earnings do not indicate strong share price performance. As depicted by this chart, this breaks down the S&P 500 sectors. And you'll notice the energy sector had the strongest earnings in the previous chart, but it was one of the worst performers during 2017. The strongest sector was information technology. Now note, even there was a significant performance difference between the various S&P 500 market sectors here on this chart, the overall stock market was very calm during 2017. And therefore, the VIX index, which is a volatility index, measures how volatile investors expect the markets to be in the short term. It was very low in 2017. In fact, since it basically closed below 10 on this chart 9 times during the year. So before 2017, just 9 times. As you can see, it closed a lot. It spent a lot of time below 11 during most of the year. The VIX has averaged 18.5 since 2004. So as you can see, it never reached that level in 2017. The highest was around the 16 range. So volatility was low. People were calm, and more people were bullish than not. 52.6 were bullish, 26.7 were neutral, and about 21% were bearish. By the way, bullish investors expect the market to increase, and bearish investors expect the market to go down over time or decrease. Now, many people thought that 2017, that would be the end of the bull market in bonds. So as you can see here, interest rates continued to stay low during 2017. This shows you a chart going back to the 1880s, and this big spike you hear were in the 1980s, and then as you can see that it has come all the way down. We ended the year, started 2017 at 2.45% on the 10-year Treasury. At the end of the year, they were yielding 2.4. Now, I will say that in 2018 so far, the first few weeks, the 10-year Treasury is up over 2.5%. That's a pretty huge move for bonds. So the bear market hasn't started yet, but could this be the year? It does in 2018. Now, the Central Council on Foreign Relations, the CFR, Global Monetary Policy Tracker, compiles data from 54 countries around the world, primarily those with central banks that target inflation. As you can see here, many parts of the world have begun to rein in monetary policy. So when this map shows here that those who are trying to tighten monetary policy are shown more in reddish colors. The more country has raised rates, the darker the shade of red. So countries that are loosening monetary policy, which means they are encouraging economic growth by lowering interest rates, are shown in blue. The deeper shade of blue, the more aggressively the country is lowering rates. So Europe is continuing to have negative interest rates, and so it's a darker blue, as well as parts of South America. But then you see places in North America particularly that are raising rates, including the U.S., raising interest rates. Now, the United States policy is becoming less stimulative. So in other words, they're increasing interest rates, so they're pursuing a less stimulative monetary policy. They've raised rates 3 times in 2017. And as quantitative easing and other stimulus programs taper off, we may see interest rates move higher in 2018. So currently, where are we? Well, many people are wondering how long this bull market can last. Some theorize it could go on for years. Others postulate it will end in 2018. Now, we've had our eyes on some market valuation indicators. Robert Shiller, who was a Nobel laureate and also who wrote the book Irrational Exuberance, he also developed the Cyclical Adjusted Price to Earnings, or CAPE ratio. The CAPE ratio is a metric that basically helps financial professionals evaluate whether a market is overvalued, undervalued, or fairly valued. Now, at the start of 2018, the CAPE ratio was at 32.64. Far right here. Its historic mean is 16.8. In other words, the market appears to be overvalued. When a market is overvalued, it means investors may be paying too much for shares of companies. If investors decide shares are too high priced, they may be unwilling to pay the price and share values may fall, meaning that demand for stocks could eventually slow down and prices will have to come down at some point. Now, does high valuations mean it's the end of the bull market? Not necessarily. In December of last year, Savita Subramanian, head of the U.S. Equity and Quantitative Strategy at Bank of America, Merrill Lynch, told Fortune magazine that she said it turns out that valuations are really a lousy market timing model. If you're concerned about what happens over the next 12 months, the amount of returns that are explained by the price to earnings ratio are basically close to zero. So people like her feel that valuations really in the short run don't matter as much as the trend of the market and are there continued earnings to support higher valuations in stocks. So we don't totally agree with that. However, history shows that this market can continue to go higher even though valuations may not support it initially. Even last June, Robert Shiller, who's the CAPE ratio creator, advised investors to be cautious when looking at valuations. He says they're not definitive. For example, in the 1990s, he states that the CAPE ratio reached 30 and continued to move higher for a couple of years. This is what he told CNBC back in June. So here again, valuations are very important, but they may not matter in a shorter period of time. The markets could continue to go higher even with the valuation levels where they are. No matter what happens to the market valuations, we could see a market correction during 2018. We're overdue. Since 2009, global markets have been helped by massive stimulus and provided by central banks. And as short-term rates reached record lows, the U.S. stock market enjoyed its second longest bull run of all time. So it's been quite a while since we've experienced a correction, which, by the way, is a temporary price reversal of 5% or more. Now, Morgan Stanley did some research, and they found from 2009 to the start of 2017, there were a number of modest corrections in the S&P 500 index. On average, the market moved down 9.1%, and recovery took 55 days. So, we're overdue for some type of correction of 5% or more. We did not experience a significant correction during 2017, so we're probably due for one. Another change we may see during 2018 is rising inflation. So when you have economic productivity improving and the slack is starting to pick up in the economy, then that's when you see inflation increase. Goldman Sachs suggests that hasn't happened in the United States because of a sizable and relatively long-lasting drag created by weak import and commodity prices. So as this drag disappears and you see this market tightening, inflation across advanced economies should move higher. And we're also expecting higher interest rates as inflation moves higher. Central banks like the Federal Reserve may tighten monetary policy. So what they do is they want to keep their country's target inflation rate at a specific target. In the United States, the Federal Reserve targets 2% inflation. So to prevent inflation from going too high, central banks typically raise short-term lending rates, which push interest rates on loans and bonds higher, and higher interest rates on loans tend to reduce consumer and business demand, which can prevent the economy from overheating. So higher interest rates on bonds would mean the end of the bond bull market. I'll be talking more about bonds here in a minute, but so look to interest rates to continue to edge up a little bit here and there several times probably throughout 2018, and naturally as the economic data comes out, that could be adjusted, but interest rates are on the rise. Now, tax reform. This could remain a wild card for 2018. So Congress passed tax reform and the President signed it into law late in 2017. Well, what will it do? Well, the economic benefits of the tax reform over the long term remain uncertain. If you can see from these charts, there was polls done by the Chicago Booth School of Business Initiative on global markets. The majority did not believe the new tax plan would substantially grow U.S. gross domestic product, which is the value of goods and services our country produces each year. The majority also thought the plan would increase the U.S. debt. Now, who knows what's going to happen, but I find it hard not to believe when you reduce taxes and it reduces particularly corporate taxes, you're starting to see more money flow throughout the economy, companies giving raises and bonuses, more American companies moving their jobs back to the U.S., which creates a better environment in the communities and the workforce. So I think there would be initially some decent tax incentives for the market. The market should continue to look at this as a positive. Now, at some point, the debt becomes an issue. But for right now, we need economic stimulus in our economy, and we're starting to see that right now with especially the corporate rate being reduced. Standard & Poor's companies, it should increase, based on Barron's research, at least $10 per share to the S&P companies, 500 companies. But it does say a major risk to the market is the potential rise in U.S. inflation, which could push the Federal Reserve to tighten more aggressively. So I think we'd all like to see a little bit more inflation. Inflation has been pretty benign, and so some inflation is not bad. And as we go through the current business cycle, you can see here that we go through phases of recovery, expansion, and then contraction, and then recovery again. And this is just a normal business model cycle. And right now, the U.S. is still in expansion. You have China, Brazil, and Japan in the early stages, Germany, Italy, and France as well. And a business cycle is a period of change in economic activity. And it's just a continuous process. So what you have to identify is what businesses during these current business cycles do better than others. So during periods of expansion, as you can see on this chart, consumer discretionary stocks, financials, industrials, and technology and real estate usually outperform. But when periods of recession or contraction, sectors covering necessities tend to do well, such as consumer staples, healthcare, telecommunications, and utilities. So when we look ahead about where we're going, we're going to talk also about some risks. This little cartoon here just has a little bull in the boat here with looks like President Trump crossing the Potomac, looks like here, and you got the little bull that has a life jacket on that says just in case. And that's kind of the way we're approaching 2018 is just in case. There's some risk out there. We've had a great market run in 2017, and we're an extended long bull run. Just in case, let's be ready for 2018. Now, the economic growth is a continued upward trend around the world. As you can see here, the economist estimates global economic growth will continue. The pace of growth isn't as fast as many in the developed nations would like to see, but growth is better than the alternative. As you can see, the highest rates of growth are in Asia, particularly China and India, in areas like that. Now, while governments and economies recover, innovation has continued apace. 5G will make its debut with a showcase at the 2020 Olympics in South Korea. Now, 5G is a new network system that has much higher speeds and capacity and much lower latency, meaning the network can process a very high volume of data messages with minimal delay. Well, to support the Internet of Things, the IoT market, 5G is expected to boost autonomous cars, which have a profound effect on people, governments, and companies. So last April in the Harvard Business Review stated artificial intelligence, AI, is transforming the automobile. In doing so, it will transform much more than that. Given how central automotive transportation is to our cities, commerce, and daily lives, saying that AI will change life as we know it is no understatement. In just a few years, autonomous vehicles may affect infrastructure, revenue streams, employment, creating opportunities, but also challenges. So just imagine a world without no parking fees, parking tickets, parking structures, speeding tickets, or auto liability insurance. If self-driving and driverless autos are electric, which most everyone is putting out only electric fleets, all the car dealers, then the energy industry will also be changed as well. So this is what you have to look for looking into 2018 and beyond, is these new technologies and how they will affect the various industries. You want to be on the right side of those. Also seeking security in a global, interconnected digital world. Another change many people agree cannot come quickly enough is improved cybersecurity. In the past, proving who you were used to be straightforward. Your mother's maiden name was enough. Today, protecting your accounts and proving who you are has become more challenging because social media and data breaches have made personal data, from credit card numbers to answers to personal questions, more readily available. Security improvements are in the works such as biometrics, which are voice, finger, and iris prints. They are effective personal identifiers. Did you know that India, for example, has the world's largest domestic biometric identification system? Since 2010, the government has collected fingerprints and iris scans from more than 1 billion residents, and each person has been assigned a 12-digit identification number. Another possibility is a distributed ledger system, like blockchain, that has the potential to let individuals control all of their personal information. Until this technology is available and proven, we suggest using 14-digit passwords and choose biometrics when it is offered as a security option. So blockchain, and you've heard a lot about blockchain when it comes to cyber, cryptocurrencies. And that's what blockchain is. Basically, it's a way to secure personal data and identifications, and you purchase that, and you can use that as a means of exchange. It could be very secure, but also very unregulated. And what we're seeing right now is a huge move in Bitcoin and cryptocurrencies, but they are very, very volatile. It's a very big fad in popularity right now, but as countries are starting to crack down on cryptocurrencies, and you're going to see most major countries starting to regulate those. So I think you'll see prices come down eventually before they go back higher. But it is fascinating, it's interesting, and this type of technology is the future, and getting exposed to those companies that take advantage of that, and perhaps even some type of cryptocurrency may be a decent investment. And it has been for many people, but it is too volatile at this time. But there are some ways that we'll be revealing in some future presentations that you may be able to take advantage of that in a more diversified way. So here are some risks as we move into 2018. And I think probably the ones that we've talked about most today is possibly higher inflation, the slack being removed from the economy, and price inflation beginning to happen, interest rates moving higher. But also one thing we haven't talked about is the U.S. dollar, and that is as the U.S. dollar has struggled lately, and we see that China and other countries are wanting to utilize other types of currencies to buy and sell exchange in the world as far as the world reserve currency. The U.S. dollar has been the reserve currency, and we're seeing China making arrangements with emerging countries to trade outside of the U.S. dollar, and this will put more pressure on the dollar over time. And then eventually you'll see prices in commodities go higher because when there's a lower dollar, it takes more dollars to purchase commodities, oil and gas, food, etc. So there's also a risk that could come from geopolitical shocks. North Korea could be one. Perhaps at Washington, the investigations that are continuing there could take a turn, whether it's a Mueller investigation, who knows. These are all different things that could affect the markets. And since the markets are at higher valuations, we could expect a correction within the market, which could be an opportunity to even purchase stocks cheaper at some point. Now here's a few analysts that I'm going to cover briefly. John Hussman is a PhD and president of the Hussman Investment Trust. He says with low interest rates and high valuations that it is a poor total return prospect for stocks and bonds as well. Candace Browning, who's head of Bank of Merrill Lynch, history suggests that some of the best returns can come at the end of the markets, bull markets, excuse me. So, we could see a continued push higher, and we could see a good, what we call a melt up in the markets, and one big last push up or trend up, even from these levels. But at some point we get a pullback, and that should be viewed perhaps as a buying opportunity. David Costin, who's head of U.S. strategist at Goldman Sachs, currently market valuation is certainly stretched, but it doesn't appear unreasonable. So he feels like the bull market could continue. And then the analysts at Schwab say that 2017 appears to be morphing into a solid start into 2018, but unlikely to be as smooth. We believe the bull market still has room to run, but could shape up to be bumpier ride as expectations and sentiment are elevated. So overall, a lot of people feel like this market could continue a little bit higher, but at some point we get a pullback and some volatility in the markets. So now I want to point to what we believe, what we employ here at Womack Investment Advisors is not trying to time the market or not trying to listen to someone's opinions. We listen to what the market is telling us, and we call this fact-based investing. So we don't try to make market predictions, even though we like to read about them. We don't require that markets or investors be rational or efficient. So it doesn't really matter that the valuations are, perhaps overvalued. They could get more overvalued. And I'll explain here in a minute what I mean by that. And we don't remain fully invested. So if we start to see the market breaking down and reversing the trend, then we want to get off the tracks. We want to preserve as much as we can. One of the ways we do this is in our research, we take a look at where valuations are and how things look historically. Now this chart, this 2/3 upper part of the chart, is showing the markets that are going back since 1900, and periods that are not green, you see, that are white here, and have the red box, those are bear market periods. So for example, in 1900 to the late 1920s or mid 1920s, early 20s, this was a 21-year where the market did nothing or went down during that period. And you'll notice below is the Case-Shiller price index, the PE ratio. As you can see, valuations on stocks in bear markets will go down. In this case, they started around the 20 range in 1900 and went down below 10 before the new bull market or advancement in stocks began. And why is that? Well, these lower markets bleed off the high valuations and make stocks cheaper. And you have to have stocks become cheaper at some point in order for there to be a long-term uptrend. As you can go through history to see on this chart, when it turns green at the bottom, the green circle means the bull market started, and then at some point it peaks out, valuations get high, and then you see a bear market. And we've seen that today. We're at about a 32 on the Case-Shiller or the CAPE long-term PE ratio. And history tells us that if we start in this range, at the CAPE being around 32, history shows us, going back since 1881, that if you start around 30, that your next 10-year return average will be 0 or negative. And why is that? Well, because you're investing in high valuation periods of stocks, so the price very high. At some point within the next 10 years, if you're starting there, the market will correct and go down. And so your average rate of return for that 10-year period is very low. Whereas you start your price to earnings ratio in the 5 or lower, you have double digits returns. So 5 to 10, you have over double digits. So this is going back roughly 200 plus years to show you, not 200 years, a little over 100 years, to show you the average returns when you're in high valuation periods or low valuation periods. So we're in high right now, and all we're trying to say is at some point we get a major downturn. We want to be ready. And secondly, we want to invest in areas that are more attractive. So we want to be more picky right now. So this is for passive buy and hold investors. Be careful. If you think you can just throw your money in index funds and forget about it, in passive investing to where you just throw it in there and forget it, good luck, because it shows that history could be very, very ugly to those people that just buy and hold, especially in high valuation periods. Now this is our main research we use. It's called the bull bear indicator. And just this top part of the chart, it just basically shows this line here. I tell people this is kind of like an EKG of the stock market. It looks at like 30 indicators of the market, both fundamental and technical. And the stronger this line is, above the red and above the green, that tells us the market is very healthy, the demand is strong, and there's not much supply, and so you have increasing share prices of stocks. And so this correlates with the graph below, which is the S&P 500 actual performance. So the time frame is correlates with the movement of this indicator. So basically, when it turns red and goes through this red line, that tells us stock prices are weak, and the trend is probably going to be reversing because there's not enough demand. And sure enough, you see these grayed out periods, like from 2000. Late 2000 to early 2003, that's a bear market. What we want to do is avoid these big, huge drop downs because it takes you many years to recover from being down 30, 40, 50%. Right now, the indicator is very strong. As you can see throughout history, there's been a few bear markets, but the first two on this chart in 2000 and then 2008 were big doozies. And you don't know how long these bears are going to last in these downturns. So you have to take some action. And what we do is try to get more conservative and try to protect our investors' principal when this happens. And we do this by going to cash, perhaps even shorting the market on a portion of the portfolio for a short period of time until we see a buying opportunity in the index. Gold is strengthened this year, started September 1st, our gold index indicator, and we believe that gold holds a lot of potential this year. It's coming off 5 and 6 year lows. It's been down for 5 or 6 years off the highs, and we anticipate gold could continue to strengthen, and therefore mining stocks should have a very good year, off to a good start. As I mentioned earlier, gold was up 12% for 2017. The energy indicator just went positive in this January 2018. Energy, as I mentioned earlier, energy sector was very much improved last year in its earnings, but it didn't perform well. Now we're starting to see energy stocks rebound and move higher. Now here's a bull-bear indicator for bonds. We're still in a bull market right now for bonds, but as you can see, the indicator has weakened on the far right-hand side here, and if we hit that red line, that means that we could see interest rates move higher and bonds move lower. So we've been in a long-term bond market advancement, as you can see, since early 2000. Well, that's it for the forecast for 2018. I encourage you to email us with any questions you might have, or give us a call. There's our local number and our toll-free number, and email us, and we'd like to send you a free risk assessment to see where you stand today in the market. And if you're not investing with us, we encourage you to do that. It kind of shows you what risk level you should be taking, and we look forward to helping you find the opportunities in 2018 and avoiding the big disasters that may come in the market. Thank you for attending. This is Greg Womack. We appreciate it. Talk to you soon.